All right, so welcome to my webinar going on Fibs, price action, Fibonacci retracements, and just firm and profit. You already know I'm CEO. Um, Basically, I know a lot of y'all have problems with how the market runs, and it's understanding. At the end of the day, you don't want to be fluent with the market. You want to move properly with the market. I want to make sure that you guys connect on an even level of understanding how the marketplace runs. And, when you look at my chart right now, you probably be like, yo, what the hell is that? Well, I'm about to break it down. Basically, I'm using very simple things, basically ocean sky, method and way, but not really. What I'm using is very good. Who's my shit? All right, we're good again. So what I'm using is very simple. I'm using pivots, which is these lines right here. A candle time and spread. So know my spread, the candle time, obviously. And I'm using 4 moving averages with supply and demand zones, which are the shady gray areas. I'm going to drop the template in the group later on today after the webinar. But very simply, I'm going to go over my moving averages so you guys understand what's the cost of me even using them. I want you to understand the way how I use them. I use them for only one purpose: support and resistance and references to trends. Example, my blue moving average is about 400, and my 200 moving average is the orange. My black moving average is 100, and my purple moving average is 50. These are all simple moving averages, aka known as SMAs. They act as support, as you can see right here, and they act as the strong resistance. Now, the way how I basically break them down is like when the 200 is above the 400, which is the orange is above the blue, it's an uptrend. When the orange is under the blue, it's a downtrend. When the 50, the purple is above the black, it's an uptrend. When the purple is underneath the black, it's a downtrend. Very simple. The lower moving average is always got to be above the stronger moving average, which is the 100 or whatever the case may be, for an uptrend. As you guys can see here, Euro USD was going into the uptrend. And, understanding about the market, and just so you can understand the consolidation breakouts and understand what's going on, you're going to have to do something called price action. And, using Fibonacci is another way of using price action, which is basically, grabbing your Fibonacci retracement. And what you can do is very simple. I want you guys to really focus and analyze what I'm about to do here. Before I even continue, I want to make sure some in the chat. All right, can everybody hear me? We're good? I'm about to go into crazy details about Fibonacci. Like, you guys are not going to be able to see what I see until I actually draw it out, It's about to get sick. So, with further ado, get ready to take some notes. And about to have your mind blown to another level. Fibonacci works like this. Fibonacci moves for everything in life, in charts, in water, in, mountains, and air, whatever the case may be. Is always about a retracement of something. When you use Fibonacci in MetaTrader 4, it works like this. You grab it from the high, as you see this wick right, grab it from the low, this wick right here, right? Or this wick right here, rather, it doesn't really matter. You grab it from this wick, and what you can do is you're going to grab it, and you're going to drag that to one of your highs. I'm going to start with this high right here so you guys can see how did this happen before this happened. Does that make sense? So right here, as you can see, what I did, I grabbed my Fibonacci line, and I dragged it to this high where the 200 moving average is at. Now, coming into the market, understand when I turn on my day breakers, this was the first move throughout the day. I did not know what was going to happen from this day forward, which is basically from right here. From this day forward, from where this arrow is at, I did not know what was going to happen in the market. All right? So what was that going to do for me? Very simply, when I turn back on my day breakers, as you can see, once again, Fibonacci took over. This was all resistance once upon a time with the 200 moving average. As you can see, it was doing an M shape, and right here the market dropped, and it fell through levels. Right here at the 23.6 level of Fibonacci, it acted as support. Went back up, touched the 200, and broke down. Tried to test back the 23.6 level. known as pullback, and kept going down in the market. Fell down to the 50 moving average, which was my support. And what happened was it also reacted on the 50 Fibonacci line. It broke out, tried to at least touch the 61.8 mark on the Fibonacci perfectly right here, as you guys can see, and the market went right back up, okay? The reason behind that is because, like I said, Fibonacci moves to everything in life. So right here, when the market went up and it crossed back with the 50 moving average, remember, these all act as support and resistance. Fibonacci acts as support and resistance. So what's happening is it takes a big candle to break it. And it also was breaking resistance with this 50 moving average as well. So that's why I got this one big candle. This was an entry that you could have possibly took from anywhere from over here all the way up to here and got over 129 pips, known as 1,298 macros, okay? You could have rolled all of that into the next day very simply by just getting on this level between the 38.2 and the 50 and the Fibonacci retracement. As the market went up, as you can see, it acted as support on the 23.6 level, which is over here. And it was also acting as a reference of breaking resistance just a little bit over the 200 moving average before it acted as a little bit support. Went back down to test that again and broke out very strongly, as you guys can see here. To touch that 400 moving average, to test it as resistance, to go back down above the zero level. Now, here's the trick. When the market goes above the zero level or the 100 level, underneath the 100 level, the market is going to retrace in a way. So right here, when it's above the zero, as you guys can see, it did an M, and the market shot right back down to go back into the retracement of Fibonacci. And here are the pivots, the pink pivot line. You want to write this down. The pink pivot is your strongest act of resistance or support. Now, when it was able to break, it takes a big candle. Like I always tell people, when it comes to trend lines, price action, support, and resistance, it takes a big candle to break it. Now, if you don't know the difference between a small candle and a big candle, let me explain. This is a small candle. These are small candles. This is a big candle. This is a normal size candle. This is a big candle. This is a big candle. This is once again a big candle. This is a big candle. Small candles, big candles, small. Well, this is like an average size candle. Small candles, and these are like normal size candles right here. So you got to understand the lengths of the candles. It takes a big candle to break support and resistance. So that's why it broke the zone. You could have gotten in order right here and scalped it pretty nasty, because this is all honestly 1, 2, 3, 4 levels of drop right here. When it pulled back up, you could have gotten an entry anywhere over there and racked up 49 pips, 50 pips. It's been done on a nice clean order. Okay? Market, as you can see right here, acted as resistance. It did a W after forming the M. The 50 was very respected towards it as the resistance zone between the 23.6 and the 0.0 zone between the green pivot and this red pivot line. The market acted as support right here, and the market went right back up. Took a big candle to break it, and it's now consolidating right between the 400 and the pink pivot. The market, as you see, as you guys know, supply and demand zones. This was the demand zone when the market chose to go back up and to go into a bullish trend. Right here is a supply zone. It did not reach the supply zone yet. And as you guys know, when the candles are bearish on the H1 chart, on the Sunday gap, it's most likely to go bullish, to get back into the zone, or even better, to go up above and get into here, or over here in the supply zone, when the market is actually going to retrace and go back down. We're expecting a huge drop for the euro based upon the shape that's forming right now, which is looking like one big M. And it's most likely to break past this level. Now, I want you guys to really look at this. It has to either A, break past this level, or it's going to consolidate around this range zone. We already know it's going to gap up on Sunday. Market's going to eventually break out and go back down. The trend is pretty strong going down, so we're going to start drawing trend lines. Just so you can understand where you are at in the trend. What you do with the trend line is you basically grab it from a wick, you get a good estimate where this market is right here, and you're going to angle it out. What I do with Fibonacci and everything, I connect it to the pivot lines. Now, you could probably be looking at it and just say, hey, Ryan, but the candles are up here. Yes, you're right, because there's another trend line that goes above that. Right here, as you can see, it's in a perfect angle of the slope, and that's why the candles are very respectful towards it. the next trend line that you're going to draw on euro will be from up here, from this supply zone. As you guys can see, I'm connecting from supply zone angles. And I'm going to draw it going down right here into another slope. So now you guys can see two different zones. One zone respecting right here the resistance, and another zone which you can take a more of an aggressive approach for the sell, which is up here, more into the supply zone. So the market wants to get a gap around here into this green range. Now what I'm gonna do is, since I already retraced all of this, and you're probably thinking like, hey, what do you do above here after it's above the zero? It's very simple. You take your Fibonacci retracement, you can either A, delete it, and redraw, or just drag it over. I usually just delete mine and draw over again. So what I do is I get my Fibonacci, I get it from my new low right here, and I'm gonna drag it up. Now you're going to see new areas respected towards Fibonacci. As you guys can see, 7.6 zone right here. It consolidates, goes up, taps right here in the 61.8 zone, and it breaks out. Clear as day. Trend lines respected amongst the 400 moving average as resistance. Touches the 38.2 zone. Goes back up, touches resistance, breaks it, goes to the trend line, into the supply zone. Fibonacci retracement is acting respectfully right here in the 23.6 zone. Candles right here acting as support. And it breaks out, goes right back down. Breaking the 38.2 level and 50 level, where it actually acts as resistance between this red pivot and the 50th level right here on Fibonacci. And respected accordingly as the 50 moving average. Before it goes back up, it retraces on the 38.2 level. It acts as a perfect consolidation, as you want to see, in the 23.6 level between this pink pivot and the 23.6 level, the trend line, and underneath the resistance of a 400 moving average, and it didn't even touch this red trend line yet. So, with that being said, do you guys got some questions on that? If you got questions, type the question now, because I'm about to get really more technical and moving on to other charts into bigger zones and bigger time frames. America, this is good for you, making sense? So far, so smooth?
Yes, sir. Making a lot of sense, man.
How do you enter the trade? Count your levels, brother. You got to count your levels. You got to know when to get in, when to get out.
And right here, for example, Fibonacci by the spike, by the wick, I mean?
What happened?
Are you always grabbing the Fibonacci by the wick?
Yeah, exactly. If you know the trend is going up for the week, most likely when it hits a new low, and you see that, the wick bouncing off of a certain zone, that's a clean entry, because you're counting your levels, you feel me? So, example, if you're counting your levels right here, you got 1 level, 2 level, 3 level, 4 levels of rise, and it consolidates. You're expecting that Fibonacci to hit a certain level before you get out. So you can either A, get it on the wick, or when it's touching that resistance, you can literally ride that shit down, because, it's perfectly timed with the Fibonacci. So when it actually finished off right here breaking out, you couldn't really count your levels right here because, it's kind of like sideways, but, you still count them like stairs. You can kind of count like this as one level. This little, these two wicks right here. You got another level right here because you can end it by the wick. This is the third level, and it looked like 4 levels right here, perfectly smooth. So you feel me? It's 1, 2, 3, 4. Golfing, consolidation. So you could guide in right here and ride it all the way up. Perfectly smooth, rack up 1,000 macros.
Nice.
Reversal patterns, of course, with levels. It's very simple. It's like when you moving with the charts, nothing could really stop you. I mean, I teach, I'm very self-taught because, I teach the way how I feel that I'm going to be comfortable in the market. If you understand these time zone patterns, you literally knock them down all day. See, this is the 19 GMT mark, which I call half New York. This is the end of London. The market went up. Follows around with Fibonacci. Right here we have 15 GMT, open of the New York session, follows the line with Fibonacci. Time zone trading, which I mentioned in my other webinar on 1K day. See how everything's in a pattern? It's perfectly smooth. And you can time it every single time. That's the crazy part about it. Moving on to a bigger time frame, I want you guys to really look at USD CAD. Because I know a lot of people have questions, they're confused, they're wilding out about it. Truth of the matter is, I kind of drew on the chart already. and I was actually, I was having fun. As you see, I drew a trend line when I did my webinar earlier. But I'm gonna do it again for you. And I already highlighted the big zone, and the trend line was very respected. So we get back to Ocean Sky template. Like I said, I'm gonna post it later on in the group. We're gonna zoom out. I'm gonna start with the H1. We're gonna look at the H1, and you guys are probably looking at it like, damn, what is going on? Well, the first question you should have done is, when you're about to start trading for the day, you always want to start looking at the monthly chart, see where you're at in the month. Very simply, you know that this is whatever happens to the left has to happen to the right. As you can see here, it's doing one big M, as it once upon a time did an M right here before it drops. As you can see, it's doing that right now. And it's actually touching that resistance. So what you're going to want to do is, zoom out just a little bit, not too much. Can't overcomplicate this. This is as simple as it gets. And you're going to take the trend line. You're going to take the trend line, and what you can do is that you're going to copy it, and you're going to go like this. Just everybody follow me so far. Remember, we just went over this. A big line breaks. A big candle breaks the trend. You see this? Perfectly smooth. Big candle broke it. This is the 200 moving average. This is my 50, and this is the 100. As you see, exactly as support. What you can do now is understand that this is in a range of support and resistance. Now, how do you figure out the zone between that? It's very simple. You go to the 1 week chart. You're just going to zoom out just a little bit more, and you're going to take a box. You know that this is all a zone, so what you can do is very simple, highlight it, and get it. Make sense? You get that zone, and what you can do is now, you're going to zoom out just a little bit, and you're going to notice that there's another zone right here. We're going to go to the day 1 chart. And you're going to realize that that same trend line is now acting as support, and while the market's still going up. We're going to go to the H4 chart, and we're going to notice something else. A breakout. I actually want to adjust my monthly chart just a tiny little bit. I put it lower down to the body for one reason. That breakout was a lot sooner when I was doing it earlier. I realized it, so my bad on that. Let's go back to the H4 chart, I think it was, or the day 1 chart. There we go. Boom. Perfect. As you can see right here, it's touching the wicks, and it took that same big candle where it broke out. This is on the day 1 chart. It just rose up, and the market just going crazy. All up in the supply zone. Right here, we see a reversal pattern happening on the H4 chart. When the market is trying to go back downward, there's a lot of pivots, a lot of action. All up in the supply zone. Then we realize on the H1 chart, it did a perfect M. So you see that's going to go down, but the thing is, since it's like gapping down, well, not gapping down, it's the red candle, most likely on market open is going to gap up just a little bit, probably get up to this zone and fall down. So what you're going to want to do is take the H4 chart, you get your A, zoom in, draw a Fibonacci line from the angle. You can take any of these lows, it's perfectly fine. I'm just going to grab this one where this big candle forms, and I'm going to grab it all the way to up here. I'm now going to go to the H1 chart, and I'm going to see how is Fibonacci retracement, acting accordingly towards all of this. In a nutshell, you're going to see a lot of accurate trends into it. Big candle breaks out. Consolidation happens between the 50 and the 61.8 zone. Consolidation once again in the 50 zone acts as support, resistance, flows perfectly on the 50 moving average. In the 50 zone once again, and goes right back up. 23.6, and this is where we're at right now in the market. So when you're expecting now the play of what's going to happen next week, right? You understand that these are all levels. So the 23.6 that was acting accordingly, and didn't even get touched yet. The 50 moving average is right now getting respected as support. We have the pivots in line. We understand that it's still in between the 0 range and the 23.6 range. It did not go all the way up to have a full retracement yet. You understand that it's a 38.2 zone down here, and the market could keep falling before it actually goes back up. Hence, why Euro USD is still going to be pushing up. Is everybody with me so far on that? Because I know a lot of people is not really understanding the USD CAD, and the reason behind that is, you know, it's a lot like that word, analyzing to understand what's going to go on in the charts. You know, if you even go to the 30-minute chart, you can even see the big wick touching down on the 50 after strong support, hitting the 100, tapping that 100, tap, right? Pulls back hard, and you could have racked up some pips. Look how the M is respected accordingly towards this green pivot. Respected accordingly so well that right now when the market started falling down, it still didn't even touch the 20.6 zone. And this is on the 30-minute chart. Some people even use the 15. I don't, but, you know, you could have got in right here on the 15-minute where it tapped the blue pivot before it went back up. I mean, I don't use the 15 for a lot of reasons. And I just stick with the 30 and H1 and up. I want to go back to the Euro USD. So you guys can check out the 30-minute time frame with Fibonacci retracements. And you're going to see the consolidation period is right here on the pink pivot. Just as well as you can see it right here on the H1, but you can see a lot more consolidated candles. Wicks to the high, no move. Even if you was trying to buy in right here or sell right here, you're going to be very stagnant. Why? Because of the area of support, which is the pink pivot, and the area of resistance is in that slope. So now we're going to go look at another chart, Euro CAD, for example. So you guys keep going. Remember, you went over USD CAD. You understand that USD CAD was going up. Now, the things in common with that chart and the Euro CAD chart is that they both have CAD in it. So we're going to realize two things. This is actually going up as well. We have a M formation forming, and we're having a breakout right now. As you can see, the first peak of the M is right here for the double top. The second peak is right here. So when you're doing that, you're going to realize that, oh, you got to draw your trends. So what you can do is you're going to go to the H4 chart. And as you can see, it's clearly in the supply zone. You cannot tell it was in the supply zone on the 1-hour chart. But on the H4 chart, you can see that as the supply zone. That's the trick, understanding when the market's about to do. So now we understand that. We're going to grab the Fibonacci lines, retracements, and we're going to find a nice low and draw it to that angle. For example, understand that since it's doing this as a quick reference to the M, I'm going to take an angle from right here, from this wick, and I'm going to do a short Fibonacci trend right here. And I'm going to understand where the market is going to actually fall through. So let me zoom in, and I'm going to understand two things. When I get my trend line on the H4 chart, I understand that I can't really draw a trend. There's no true, real angle. And by determining that, I can just look at it and I can tell that I can't really draw that trend. There's no possible way. Like, it's too far out, no connections. So we understand that there's no trend. And that's on the H4 chart. So the only thing you can do is Fibonacci. That's why it's very important to understand this. Market touches right here at the 0 level. Right here. Falls down, touches that support. 23.6 level. 23.6 level is respected. Candles pushing, and most likely is going to have some, balancing right here between the 61.8 level because the pink pivot line is right there, and we understand that's the M, and we're only on the first level drop. We can have some retracement. It's probably going to come up to the 50 level and 38.2 level before it actually goes back down. The Sunday market, when it opens, it's going to gap up. So it's most likely going to touch around the 23.6 level or the 0 level before it actually really declines all the way back down. Anybody got questions? Because I know there's a lot of people in here right now. I'll wait till it goes down 3 levels before I enter trade for it goes back up. Correct. I'll always expect a fourth. And the best way that you can determine if this is going to reverse is the reversal pattern. Especially with Fibonacci retracement, it's like a double confirmation. And you're just going up for support and resistance. And believe it or not, guys, I want you to really understand this. If you know it's in a good zone of Fibonacci, and you see the pullbacks and all that stuff happening, and the levels are right there, you know how much value you could put on a good setup like that and rack up? Because at the end of the day, if you're using low value and you understand the system, If you use a super high good size value for your account on a tracement or just like this, you could have really racked up. Even though the spread is 21, just on weekends the spreads go up. You could have really honestly made 1,000 micros, man. 100 pips. You throw a 10 lot on this, guess what you come out with? 10 grand. Throw a 5 lot on this, come up 5,000. Throw one standard, come out 1,000. Throw out two standards, 2,000. Throw out 2.50, 2,500. You get the concept. And it's all because you understand that it was doing an M and the market was about to retrace back down and it fell in line with the 50. The red pivot was in this is in the demand zone and the market was just gonna go back up. Now, believe it or not, you could kind of sort of throw a trend line right here into that angle to determine what's going to happen in this trend. But guess what? You understand that it's falling down in levels, and this is only first level drop, and it's into a downtrend. You already know it's going to break this. So it's like to throw a trend line right here is kind of pointless. But, just for common sake of drawing a trend line, that's what you would have done. Connected to the pivots for a good angle of slope. I want you guys to actually look at this as well. You want to double click the trend lines, go to trend line properties, go to perimeters. You can thicken your lines if you want to, but you go to perimeters and you get an unchecked array. Checked. This is what happens with checked. It stands all the way out. There's no play with it. You go to trend line properties, unselect array, and it goes back to small, and you can play with it. Well, you can draw your Fibonacci traces anytime you want to, but I just know that every Sunday the market gaps, and with a lot of experience of witnessing a lot of the gaps back like a couple of months ago, I was actually trading a lot on the H1. When the market would show me like a bullish candle, I didn't know off rip the market is gonna gap up, and the market when it gaps up is gonna go into the bullish candle. And then it's either going to fall back in line. Sometimes the market will gap down and go into a bullish candle trying to retrace the gap and fill it back up before it goes back down. So it could go in a couple of ways, but I know the candle that's going to open up on Sunday is guaranteed to be bullish just because this is red. And most of the time it's going to gap up. Because what happens is the weekly high and the weekly low is going to open up on Sunday and they act as support and resistance. A super strong support and resistance like this pink pivot line, so it's going to bounce off of it depending on where the trend is. So this is like a car going into a wall. This goes down into the wall, this one's going to reflect off of it and shoot up. If this is going up into the wall, it's going to reflect off of it and shoot down. That's the best way of explaining it. Now, there's no guaranteed trade I do on Sundays, but if I leave my trades open, I know that if it's going to gap up and it's an uptrend and it's doing that in my favor, man, you could rack up on pips, especially when you're holding the trade. So sometimes if I know I was holding a trade from, let's just say, for example, I was holding a trade right here, and I saw that the market was going to go back down, and I didn't pay attention for the last 3 hours. By default, I'm going to close it when it gets to like around this range on Sunday and just close the hell out my trade at 5 o'clock once the market opens and rack up my pips and be happy with it wherever I get. Sometimes it'll be like triple what I had last time when I was looking at my profits. Let's go to another chart. AUD USD. And as you guys can see, I was drawing on this earlier. But you just do this again, clear it all up. As you guys can see, it was all up in the supply zone. Alright. You get a trend line. You're going to want to zoom out. You grab it from this angle. And you're going to draw your first trend line going down here. Just so you can see what happens. You're going to connect it to the red or green pivot. Green pivot is actually pretty nice to connect it to. I'm going to show you I'm going to connect it to the red pivot. The reason why I did that, as you guys can see, it taps. Market fell right here, whatever the case may be. I'm going to go over this whole entire section with AUD USD so you guys can really understand the sideways market with Fibonacci. And I also was joining into a lot of uptrends, and I didn't do a downtrend yet. So as you guys can see right here, the trend line right here was respected. And I drew it all the way down, and eventually a big candle actually broke this trend line as well. And it took a big candle to break this trend line as well over here. So let's start with this area. We're going to zoom in just a little bit. And we're going to go with some Fibonacci retracement. I'm going to get it from this high and drag it to this low. I lied. I'm going to drag it to this low. Actually, no. I'm going to drag it to this low since it's the first low. Be more realistic. Fibonacci respects. I'm not going to go by what you see over here because this is me connecting it. Right here is where the fun begins. Market does a W, gets to that 23.6 level, goes back down. As you guys can see here, the 0 level was actually acted as support. You could have got in on that hammer right here, anywhere around here, and racked up some pips. 84 pips. Market goes up, acts as resistance, becomes support, breaks it, gets to that 50, gets to that 100, touches that 200, market goes right back down. Respects right here in the 38.2 zone and the 100 level of the moving average, and coasts right across it perfectly smooth. Now, here's the trick. Remember I told you guys that if it's underneath the 0 level, or if it's above the 100 level, it's going to retrace. Well, here's a perfect example. Market went back up, touches the 50. Right here, bounces right back off, touches the 50, takes 3 hits. Market tried to reverse, went back underneath the 0 level, and guess what happens? Market goes right back up. Market goes right back up with a morning star pattern, shoots up, could have racked up another 92 pips right there. It broke the trend line as well and bounced off the 50. Breaks the 100, breaks the 38.2 zone in the Fibonacci, breaks the 200, consolidates a little bit, goes up to the 70.7 zone, and then falls right back down. Boom. Market goes right back down. So what you can do is you're going to get another trend line. You're going to grab it from right here, and now you're going to slope it out. Put it right here into this green pivot, and we're going to look at it perfectly smooth. Trend lines all respected, correct? So what we're going to do is we're going to take the Fibonacci. Once again, we're going to delete it and get some new measurements from a new low or a new high. In this case, this is a downtrend, right? So we're going to grab the Fibonacci. We're going to grab it to right here. Come into the market, put on your day breakers. You're going to figure this out. Understand, this is a day, this is the day, and this is another day. So right here, Fibonacci is respecting the 88.6 level. Consolidates between the 200, 61.8 level, and the 70.7 level. Respects the trend. Market goes down, consolidates right here. Did not go underneath here for a full retracement, but consolidates. Market goes up, 23.6 zone, breaks the pink pivot, which was over here once upon a time. Goes through the 200 moving average, the trend line, touches the 38.2 level. Trend line is all respected, it breaks out. Breaks the 200, breaks the 50, and breaks the 100. Could have racked up a lot of pips off of this one little breakout. At the end of that, 50 pips would have been done for the day. This is news, by the way, at 8. Because I noticed this 15 GMT mark right here was trading that. Don't want to really talk about it too much, but market breaks out, goes underneath the 0 level. As you guys can see, it's supposed to have retraced, but guess what? Sometimes it don't, and that's perfectly fine. Why is that? Because if it's underneath the 0 level and it didn't retrace, guess what happens? Free falls. Also, you already knew it was into a downtrend, so it made no sense to take that as a buy, especially if you know your days. If you count your days right with the maybe reversal setups, you understand this is only 1, this is 2, this is 3, went back up, and this is the 4th hit to the low. So when you go back and we look at this, we understand that these two trend lines are actually respected in the consolidation periods. Market shoots down, and now we got a new high, right? So we're going to take the Fibonacci lines, and we're going to determine what's going to happen later on in the market. Market breaks the 38.2 zone, breaks the 23.6 zone, respects right here, this green pivot, goes up, respects the 22.6 zone, the green pivot, once again, goes underneath it, touches the red pivot, then it goes underneath the 0 level, it consolidates. Market is trying to do a W. Most likely it's going to go up, touch the trend line, go back down, then go back up. Does anybody have questions to that? It really does matter, Richard. You want to draw, if it's an uptrend, you're going to want to draw from the low to the high. And if it's a downtrend, draw from the high to the low. Just as the trend lines. If you're going into an uptrend, you're going to want to draw more trend lines going from the low to the high. And if it's uptrend, draw it from the high to the low. Anybody got questions? Actually, you already went over like how everything is accumulated with support, resistance, Fibonacci trend lines.
Five or anything?
If you want. Oh yeah, go a little further. Just a little bit, not too much.
There's how the FRS we want.
For trash, please.
There's 27 people here. Anybody got questions? America, you good? Everything understands?
Hey, Ryan, can you hear me, bro?
Yeah, I can hear you.
Oh, man. Y'all probably heard what... I'm not sure if y'all heard me about asking for french fries, so I didn't know my stuff was unmuted, so my bad.
Now you go.
All right, sorry about that. So when you draw your fib lines, you said you just go from the lowest to the high, right?
Yeah, if it depends. If it's an uptrend, I'm gonna draw from the low to the high. If it's a downtrend, from the high to the low. Same thing with trend lines. If it's a uptrend, I'm gonna draw from the lowest wick to the highest, and then from the downtrends from the highest wick to the lowest. It's the same concept because you're gonna want to have angles. You're gonna flow with the trend. The minute you start flowing with the trend, everything's gonna become, foreseen for the future of the market.
Okay. All right, because I think that's what my mistake was, is that I will probably go from, like, that lowest candle, like that starts at the 21st at 5 o'clock, and I'll go to the highest candle that starts at 23 at 1,300.
I ain't gonna like that. You just want to flow with it smoother. The green line when you draw. What's a green line? How do you draw? What's a green? The green line's a pivot line, Richard. The pivot lines are basically supporting resistance zones, and I'm drawing it to there because that's where it's going to connect to later on in the future. Basically, what you're drawing is a canvas that's not painted yet, but you're basically having a play vision of what you're going to see later on in the marketplace. It's market's eye view. Everybody's connecting. Everybody understands. I'm going to do another chart. Let's go to USD CHF. This is one of my favorite charts. Perfect. As you guys can see here, this is one of my favorite charts for a lot of reasons. It's very trendy. Very trendy. Let's draw Fibonacci. Let's start off with going from this high and drawing it right here. Market was going into a downtrend. And as you can see right here, if we get a trend line, and we try to draw something right here, we're going to notice something. trying to get it right here. Pink pivot. Bam. All right. We're going to notice one thing. Big candles all the way over here acting as support. Candles broke it, candles broke it, candles broke it. Market's trying to go into an uptrend, is reaching newer highs. Fibonacci gets drawn out, acts as support and resistance right here. Support on resistance, support, consolidation, no trade. When the candles are between the Fibonacci line like this is clearly no trade. Let me highlight this for you. This equals no trade. Market goes back down. This is an entry, but in free falls. 23.6 got respected. You saw a pullback, you probably, would have been freaking your mind out. The reason behind that was, is between this 100 moving average and the market was actually trying to go up, reaching higher highs, and it's been having a lot of stagnancy. Market goes down, touches this trend line, which is what I drew. So now you're determining what's happening after that. This is clearly into a free fall of a downtrend. 61.8 zone and the 50 zone consolidation goes between the 50 average and the 100 average, gets between that 50 to 38.2 Fibonacci points. Acts as support, goes down to 38.2 zone to 23.6 zone. Acts consolidation, touches the 50 moving average one more time before takeoff. Goes underneath the zero, remember what I was mentioning earlier? Market retraces. See how beautiful it works? So you when you see the market doing this, you're like, shit, I got a play coming through. It's so clean. You will fall in love with Fibonacci. Draw a trend line going up from right here. I'm gonna connect it to this blue line all the way up here just for the hell of it. Right here, all Fibonacci, man. Underneath the 200 moving average, clearly underneath that zero zone, market goes up. Could have racked up so much pips. Reverse the pattern right underneath that zone. That's your entry. Could have rolled that all the way up. 84 pips. High value. Could have rolled out for the day. Got out. Whatever case may be. Gets into that zone, the 38.2 zone. 23.6 zone. Respects it. Goes back up. Consolidates just a little bit. Hits the trend line. Tries to go down. Doesn't really respect it. Why? It's because we're waiting for that full retrace, which is what happened here. So you already knew what the play was. Touches that 50, breaks out, passes that 100, gets respected right here while it tried to go down. A lot of support pushed it back up. It tried to pull through the 100 moving average, tried to push through the green pivot. Market goes up, consolidates, boom. Touches that 50, goes right back up. Reverses, consolidates, 100, 61.8 zone and 50 zone. A lot of consolidation, a lot of warring right there. Not really a solid trade. Does the M. Shoots right back up. Hits that 50 moving average, 38.2 zone and 23.6 zone. Goes right back up. Tries to do a double top from this M. Performs it beautifully. But guess what? We're looking for a better entry up here. Market's going to gap up. As you know, red candle right here. This one's going to go bullish on Sunday, get to this zone, the 100 zone, and probably just going to retrace all the way back down. When it passes this area, you already know what the play is. It goes right back down to the market. As you also can see, this big wick that forms also got fairly close to the pink pivot before it pulls all the way back. Those dollar lines are known as pivot lines. They're an indicator called SDX pivots. SDX TZ pivots, which is also found in the group. AUD USD, for example. Let me go back to it. Since I know AUD USD is about to go back into uptrend, I also understand that it didn't fully go underneath the zero level, so I'm waiting for the full retrace to actually go back up. But for the Fibonacci, since it is going to go for an uptrend, I'm going to take my Fibonacci lines, and I'm not going to do it from the high, from the low. What I'm going to do is I'm going to take my Fibonacci, take it from the low, and drag it to the high. But there is no market for me to drag it to the high right now. So I had to leave my Fibonacci retracement alone until it gets to that new zone. And I'm obviously going to wait for the confirmation to reverse the pattern. And I'm always going to count my levels before I even enter a strong uptrend of a trade. Andrew, can you specify what chart you want me to draw on July 20th at 5? Me and Ocean, we trade similar, but trust and believe, man, we don't trade like that very close. Remember, I'm not Ocean. Ocean trades his ways, I trade mine. But dragging it from, I don't do Fibonacci day to day. I do Fibonacci from a good standard point of a high going into newer lower lows. I don't do mine every single day through intraday. I'm gonna show you why. I'm about to do it though. Best entries are at the 0 mark and at the 100 mark for full retracements. You gotta count your levels, Richard. That's the main reason of why, when you look to the 23.6 level, 38.2 zone, all of that, it's all about, knowing your levels, where you're at in the market. Because if you understand where it's at in the marketplace, following in within the retracements, I have a video on levels. Rico do too, Marco does too as well. But following in with the levels, they're gonna always want to, figure out your consolidation points. If the market is gonna do this through consolidation, of course it's no entry. But if you know that the market was gonna do a W, this is a leg right here, you could have expected what was gonna happen. But the fact that it was into a strong downtrend and it did a W into a downtrend without really doing a full mimic reversal or getting underneath that 0-0 level, you can easily tell that the market was going to go right back down into a downtrend. It was going to go into a strong uptrend because the W to the low that early in the game makes no sense. Inkius, let me go look. I'm going to scroll up. Those dotted lines do coincide with the Fibonacci lines in a way. The reason why is because the pivot lines, those dotted lines or pivots, start acting as support and resistance. Let me zoom out so you guys can really see this. I'm going to clear up all, well, not really. I'm going to leave the chart alone. These dotted lines right here are the pivots. They're support and resistance. These trend lines are support and resistance. These moving averages are support and resistance. The Fibonacci lines are all support and resistance. So everything as you can see here is pure price action. There's nothing really special about it. It's just support and resistance all over the charts and trends. If you could follow the support and resistance, you know when the candle is going to break through these trend lines or break through these support and resistance zones, or when it gets to the supply zone or underneath the 0-0 level or above the 100 level, you're going to be able to rack up a lot of pips because you're going to know the trends. You're going to know when it's consolidating. You're going to know when to get out. Everything is just going to be so smooth because once you start breaking through these moving averages, you can see bigger candles. Big candle right here, breaking through these moving averages and trend lines. Big candle right here, breaking through these moving averages right here. Let's go back a little bit. There's no pivots here, but big candles breaking through these moving averages. That's why I love using them. Big candle right here. Another example. These pivot lines. The pink pivot line, like I mentioned, is the strongest pivot line. It was over here once upon a time. It was somewhere around here and it broke it. Levels determine that and time zone training determine that. If you want more references about entries, go to my 1K day training video, and then I go over a lot of periods about entries. This is more of advanced training. Once you understand that concept about time zone trading, you can literally get in on these trends at the perfect time. I'm going to go back and look at a whole bunch of times, and I'm going to get back to everybody else's questions. I'm going to just go break this down just a tiny little bit. Let's go look for time zones. 19 GMT, for example, It's called half New York. The market was going up all of London. London stops at 12 p.m. Eastern time, which is also 19 GMT right here on this NT4 time chart. At 20, the market started going back down. Well, now, the reason why I'm going over that is because whatever happens in London, the opposite must happen in New York. This is all of London. This is opposite of New York. So that's how you can determine an entry, and it falls in line with Fibonacci. So if you saw it shoot back up, which made no sense, most likely it was going to go back down anyways. 15 GMT is also another move. 3 to 4 GMT, 7 to 13 GMT. Right here is the 7 GMT mark, and we're going to go look for 13. 13 is right here. Market goes right back down. I mean, if you guys want, go look at the 1K a day video. It specifies a lot of those entries. I just randomly just did it just by looking at my time zones. I don't draw manual lines because the Fibonacci handles that, and the pivot lines handle that. And then technically I am manually drawing them because of the Fibonacci. That's the crazy part about it. It gives me more of a precise zone, so I don't have to draw all my lines all the time. But if I do have to draw my lines, I mean, I can. I mean, this is another tool in my inventory in my brain. It's always good to draw yours, but at the end of the day, if you go in with Fibonacci retracements, it's a better pullback, a better entry. Supply and demand zones work like this. I basically have the indicator up, supply and demand, which is right here. I just shaded mine gray. As you guys can see, light gray. You can draw them your own, but it's basically an area of support and resistance. As you guys can see, let me go naked. I mean, you see a lot of it right here, but I'm going to go pure naked right now so you guys can, honestly really, really see it. It's very simple. See all this consolidation? What you can do is you can take it from this wick and draw. Not too much out, but, you could literally draw all the way out if you want to. But you're going to want to, do it very smooth. Now, what you see right here is a wick right here, and I drew it to this body a little bit right here. All of this is a supply zone. Yeah. Let's draw some more. Let's go to the H4 chart. That's all supply zone. We have another supply zone right here. I mean, you can do this all day, but you kind of get the point. You can draw them manually, whatever the case may be. But if you just have the indicator just before you, it's not really a necessity to draw it. And it's not really about testing the areas, by the way. Like I said, it's all about the consolidation that happens in the area where there's a lot of strong resistance within that area. As you guys can see right here, strong resistance is within this area. That's the supply zone. Once again, strong resistance within this area, supply zone. Just testing it. See consolidation. Boom. Falls out. This is on the H4 chart. So when I go to the H1 chart and I zoom out, I'm going to see it just like this. Consolidation, back in the supply zone, market falls out. You just got to have fun drawing. Anybody else got questions?
All right, so Ryan, when you draw your supply zones, can you hear me?
Yeah, I can hear you.
Okay. So when you draw your supply zone, did you say that you have to draw from the highest wick?
I draw from the highest wick to get a better angle because I believe when I draw off my wicks, I see a better precise point in the market. The reason behind that is because once upon a time, that H1 wick was somewhere on the M30. I'm going to show you what I mean by that.
Okay.
What the hell just happened? Whoa. All right. Let's go right here. Or it's on the 15. It's one of those charts. Anyway, so look. Perfect example right here. See how there's a wick?
Yeah.
Let's go to the N15 chart. See right here is still part of the wick?
Yeah.
Let's go to the N5 chart. Crap. I lost it a little bit. Oh, I know why. No, wait. This is my candles times because I have it. Oh, that's my old computer. Wait, I got you. I want you to really, really look at this. You're going to see a big difference, though.
Okay.
Once upon a time, that wick was candles. That's the moral of that story. But right here, see that? Candles? More candles? The same type of thing. So on the N1 chart, you can realize if I could go back that far, because, you know, this is a little different. Nah, it's not allowing me to go back that far. But on the 5-minute chart, like 1-minute chart, eventually that was all candles. But that's why it was like the wicks on the higher time frames. So it's always good when you're on a higher time frame, you know, to catch that wick. Make sense?
Mm-hmm.
Because that's multiple times with candles, so you already know it's already touched that highest resistance. So you might as well take advantage of getting that slope. Why miss out on what the charts is already accumulating? You feel me? Like, there's just data that is already there. So if you're getting full data of your analysis, you can have a better decision in the marketplace. So let's just say, for example, if I took it from this high and I want to draw a trend line, you're going to notice one thing. It broke out. See, look, this trend line was eventually a candle. I touched it through here while these candles were trying to pass it. But look, I kind of caught this one because it was in an angle. As you can see, it was kind of slanted. It gave me a nice trend, like a nice trend seat right here, so I could place my trend line on. That's where you can see right here, it went down. Eventually, it acted as support and went back up and took a big candle to break that.
Yeah.
That's what's crazy about trend lines. It's just like once you really understand this game, everything becomes so smooth. Like it gets fun because I can just do this when I'm bored. I'll just play around with my charts. See, I did that just for the hell of it. Did a W, respects, goes up, trend line, not even necessary anymore. Fibonacci took care of all of that. See, same trend line that I drew when it broke out. Look what it did right here, 78.6 level, and it free fell. And it did an M. I'm just really, really ugly. Boom. M. W. M. Big M. Falls underneath here, tries to go back up. Boom. Falls underneath here, goes back up. Boom. Falls underneath here, goes back up. Free falls. Make sense? Kind of went too much details.
Yeah, I got you.
I go crazy with it, man. Like, I really go into it.
Yeah, you got the stuff in your sleep, bro.
Yeah. It's like sometimes I take breaks of trading. It's like, I don't know, I get bored sometimes. I ain't gonna lie. I really do. I don't know, I just still a lot for me to learn, you know. I'm not really that fully experienced as I want to be. But at the same time, it's like, if you play around with your charts by natural, you're just going to get really good at this. Because if you look at the same patterns every single day, you're going to want to fall in love with more price action. Like, I'm a price action fan, yo. Like, I don't know, I love price action. Like, if you understand price, you're going to make a lot of money. Because your profits is only these candles. If you can understand how they move, your profits are going to move just with it. And that's the best part. And understanding the times that they move, man, it's like you can determine the future every day within the marketplace. Like this big breakout had to happen with one of my time zones. I promise you that. 15 GMT. You know how I mentioned that earlier, right? Charts don't lie. It's just that easy, man. The supply and demand zone, I tie in with the FIBO, is because it's another way to trade. I mean, we go over that in the other videos. You got to watch all of the training, but supply zones is very simple. It's basically part of price action. When the market is high, you sell, and when the market is low, you buy. It's that simple. Demand, when price is in demand, demand means buy. Like, people want to buy that product. When it's supply, you're giving it away, so you want to sell that product. So when it's in a high, you want to sell it. That's all supply and demand really honestly is. A lot of people sold it. It's oversold. Market needs to go back down. That's what supply zone is. Market is too low. There's not enough product. People need to buy it for the low. Like, just think of a drug dealer. They're going to sell it, try to get as much product gone as possible. So you can sell for $5, $10, $20, whatever the case may be. I know it's a bad analogy. Holy shit. But, the market is eventually go back up. Just to get that product out of there. Oh, yeah, you can. It's true. Is breaking out by understanding price. If you understand price, like, you will know when the chart is about to have a breakout by looking at the moving averages, looking at support and resistance, counting your levels. It usually breaks out by passing a moving average with a big candle, or it's basically, doing an M, catching the last leg of the M, that's usually a breakout. Catching the last leg of a W is usually a breakout. Last leg spike on letters. I just want you guys to really focus on that. Last leg spikes on letters. That's the best way to describe how to catch a breakout. And when it does a retracement, it has to be underneath the 0 level or above the 100 level. If it's underneath the 0 level, most likely it's going to go back up into an uptrend. When it's above the 100 levels, most likely going to go into the downtrend. Any other questions? Oh, and by the way, see how this is underneath the 0 level? This is as easy as it gets. It was way too oversold. Tried to go back up, didn't have enough contracts. This is clearly not a good zone for it. Market does a W, pretty ugly W though. Goes right back up. Supply zone. It's really that easy. Moving averages I use. I'm gonna put my template in the group, so this will make it more simple for you guys. But the moving averages, let me pull that back up. Boom. All right, same breakouts that we were looking at earlier. Same supply and demand zones, pretty much. This 200 moving average got broken through. Right here, it had a little pullback because of that 100 moving average. 100 moving average acted as, we would call that thing resistance. Pink moving average is my 50 acted as support. Write down these moving averages. Matter of fact, I'll type it. Screw it. I use 200 so you guys can see it. SMA. Wait, I lied. 400 blue. Alright, 400 blue SMA. SMA stands for simple moving average. Here's an example of what that is. Method simple. 400 blue SMA. I use a 200 orange SMA. I got a 100 black SMA. I mean, you could choose your own colors. You don't have to do my colors. I mean, this is just for my mentality. My mentality is pretty retarded. I'm gonna be real. Like, if I tell you my method of why I put those colors, you probably will laugh at me. 50 purple SMA. But, I'm kind of like always like Spain and shit, so let me just go over it. The blue and orange, that's the normal standard pillars. Always have those colors. Didn't really have no method behind that, but but then I always had to be smart. So blue, I think of it like water. The sun is now underneath. The orange one is acts like the sun. The sun is now underneath the water, which makes no sense. When it's above the blue, that means the sun is now rising. Now, if you guys are familiar with the movie Soul Plane, it's so retarded. When the 50 moving average is underneath the black moving average, the plane is landing. When the purple moving average is above the black moving average, the plane is trying to take off. And when it takes off, it can either go above the sun and above the water. Go figure. That's just my analogy. I mean, it's pretty stupid, but that's what I have. Anybody got questions? Yeah, you gotta keep it simple. Like, I trade so simple, it's ridiculous. That's why I am where I'm at. Because ever since when I started, I try to make it less complex on myself. And the best way I feel like when you was a baby, I always went by like the stupid little red ball analogy. You always try to get that red ball. It didn't matter if anybody said no, you could try to get that red ball. When I realized I wasn't making the money I wanted to make at my job, I just wanted to understand Forex, and nobody could really tell me no. And then, somebody told me something stupid one day at my job. He's like, you can't really understand Forex. That chart goes up and down. You need to put $5,000 in the stock market to be successful if you want to trade. And I just laughed. I was doing binary options, and you know what? 2 weeks later, I quit. I stopped binary options, and I was trying to work, And in December, I was like, screw this. I wasn't making enough money to get Christmas gifts. And I was like, fuck. In January, I just went all in, and ever since then, man, it's just been crazy, like a crazy ride. And this was an analogy, so I would just put in my head to really understand this market. Like, you guys, you basically getting a blueprint of what I learned for myself. And the matter of the fact is, I just never gave up. I will draw my charts as much as I can every single day. Every single day. It didn't matter what I was doing. If it was a bad day, I'll draw my charts. Don't mean I'm trading on the bad days, but I'll draw my charts as much as possible. I'll wait till the market reopens to, get a better feel of what's going to happen. On AUD USD, for example, where the Fibs lines, let me draw where it's at. Fibs are right here, nowhere to be found. Oh, wait, I got to draw it again. From this high to this low. And if I want, I can try to figure this out if it actually was in respect of this level. And if I draw from this wick, where this long wick happened before all of this happened, it looks like it's in a nice retrace zone underneath the 0-0, and it consolidated for more than 90 minutes. So the market could potentially go right back up. So the market went right back up. But the thing is, man, the thing about Fibonacci, that's one analysis you could do for that 0-0 retracement. Or you could do here. Just that the market is rapidly falling so much, that's why I would draw it from here, and it's in a little supply zone, a little demand zone, so the market could go right back up at any time to this 23.6 level. Thing is, I don't see a full W, so I don't have no true confirmation of full retracement right now, or any type of good level of a setup. I understand this is the first level rise, but these are your give or takes. You draw from there, or you connect it to there. I just want to know what the real move might be from the market when it open. All I know is that it's a strong downtrend. And I know this is a lot of pips getting taken out. If the market goes above 50 plus pips or 100 pips, it's usually that's the trend that the market's going to run it for a while. All right, so any more other questions? Yeah, I trade on my phone. Of course I trade on my phone. I post it all the time in the group. I'll post it today in the group as well, and I'm going to load up this template. But I'm going to load basically everything that you guys can see. You know what? I'm going to be super lazy. No, I'm gonna have to type it out again. Shit. It's the same movie averages, but a little different colors, and I use fractals. If you guys are familiar with fractals, you could go here, go to Bill Williams, you click fractals, and then you just click OK. Whoa, wait, do not. Shit, this is horrible. Alright, I made them smaller. I use these on my phone. When the arrow is pointing up, the marker is going to go down. When the marker is pointing down, it's going to go up. And this obviously seeing it going back down, it says going back up. I trade with these on my phone, but it's not really a necessity on a computer. Screw that. Don't use it on the computer. Just don't use it on the computer. I shouldn't even show y'all that. It's actually bad. Use it on the phone. More of that story. Phone trading is a little more complicated, but if you have these movie averages and you understand that you could draw your analysis on a computer, you can already draw the same crap on your phone and understand time zone trading, and you'd be like, damn, these are the moves that's gonna happen for the day, and be mobile. The reason why, and that's one of the reasons why I even bought myself the new MacBook, because it's light to carry around and my phone has a hotspot. I'm even thinking about getting a new iPad just to carry it around, just so I could draw my charts. Become a fanatic of drawing your charts when you're bored, and practice this price action as much as possible. Still to this day, I still practice price action ever since I started trading. Anybody else got questions? If that's no more questions, I'm gonna end the webinar so I can post it up for you guys in the group. All right. With that being said, forever in profit. You already know. Stay blessed, stay focused, get pips, and let's make this company a better company.